Welcome friends, this is CA Ganesh Jindal. I am here to discuss the provisions related to abolition of dividend distribution tax and income tax rates applicable for assessment year 2020-21 for domestic company. So let's begin. Dividend distribution tax. The dividend distribution tax is a tax levied on dividends that a company pays to its shareholder out of its profits. The dividend distribution tax or DDT is taxable at source and is deducted at the time of the company distributing dividends. The dividend is the part of profit that the company shares with its shareholders. The law provides for the dividend distribution tax to be levied at the hands of the company and not at the hands of the receiving shareholder. Abolition of DDT was a major amendment brought by Finance Act 2020. According to our Honorable Finance Minister, the revenue foregone due to DDT removal will be Rs 25,000 crore. We shall first discuss the income tax provisions which were applicable up to 31st March 2020, that is before abolition of DDT. We all know that dividend was taxable in the hands of companies at the rate 20.56%, which is inclusive of surcharge and cess. Then this dividend on which DDT is paid was exempt in the hands of shareholder by virtue of Section 10, subsection 34. Similarly, dividend income from mutual fund was exempt under Section 10, subsection 35. Then Section 115 BBDA, which was introduced in Finance Act 2016, which was applicable only on resident individuals, HUF and firm. Individuals, HUF and firms having dividend income from companies above Rs 10 lakh were required to pay tax at the rate 10% on dividends so earned. So these were series of sections applicable on resident taxpayer before abolition of DDT. Now coming to scenario post abolition of DDT. After abolition of DDT from 1st of April 2020, dividend income shall be taxable in the hands of recipient as per their respective tax rate. Accordingly, two sections of TDS, that is section 194 and 194K, shall be attracted on payment of dividend in case of resident. Further, section 80M has been introduced which would avoid double taxation in case of intercorporate dividend. Now, if a company have declared dividend before 31st March 2020 but distributed the same after 1st April 2020, then what shall be taxability? Whether old provision will apply or new ones. Government have clarified that old provisions shall be applicable in this case. DDT will be required to be paid and then it shall be exempt in the hands of shareholder. Now coming to TDS under section 194. This section is an old section but was not applicable on dividends covered under section 1150. Since section 1150 is no more applicable on dividend, companies distributing dividend to resident shareholder shall deduct TDS at the rate 10% if the amount payable exceeds Rs 5,000. Now coming to TDS under section 194K. Section 194K is a new section added by Finance Act 2020. In case of dividend payment by asset management company to unit holders, TDS shall deduct at the rate 10% if amount of dividend exceeds Rs 5,000. This section is applicable on resident unit holder. Section 80M. In order to reduce cascading effects on intercorporate dividend, this section is introduced by Finance Act 2020. This section allows deduction in case of intercorporate dividend and shall be applicable from 1st of April 2020. First, let's understand what is intercorporate dividend. Suppose company A pays dividend to its shareholder company B, and in same financial year, company B declares dividend for its shareholder. In this scenario, company B can avail deduction under section 80M. Both company A and B should be domestic company. Amount of deduction shall be equal to amount of dividend received from company A, but it shall be restricted to amount of dividend distributed by company B, and the dividend so declared should be paid up to prescribed date. Prescribed date shall be 1 month prior to return filing due date. Let's understand this with the help of example. Case 1. Dividend distributed by A Limited to B Limited is Rs 10 crores. B Limited declares dividend of Rs 12 crore to its shareholders, and it is distributed 1 month prior to return filing due date, that is before prescribed date. Deduction under section 80M shall be Rs 10 crore in this case. Now coming to case 2, dividend distributed by A Limited to B Limited is rupees 10 crores. D Limited declares dividend of rupees 12 crore to its shareholders and it distributes rupees 6 crores before prescribed date. In this case, deduction under section 80M shall be restricted to rupees 6 crore. The deduction available to domestic companies can be summarized as follows. Amount of dividend received from domestic company or amount of dividend distributed 1 month prior to due date of filing return, whichever is lower. Hence, in case 2, we can see that the amount declared by company B was rupees 12 crore, but it distributed only rupees 6 crore up to prescribed date. So deduction under section 80M was restricted to rupees 6 crores. Now coming to income tax rates for assessment year 2020-21 in case of domestic companies. Basically, there are 5 categories. Firstly, companies having turnover up to rupees 400 crores in financial year 2017-18 shall pay tax at the rate 25% and MAT applicable to them shall be 15%, which was earlier 18.5%. Surcharge and cess shall be levied as applicable earlier. Then coming to companies having turnover greater than rupees 400 crore, the tax rate shall be 30% and MAT shall be paid at the rate 15%. Here also surcharge shall be applicable as applicable earlier. Apart from this, there are 3 optional sections, that is section 115BA, 115BAA, 115BAB, which can be opted on fulfilling certain conditions. Let's discuss them one by one. Section 115BA, that is 25% tax irrespective of turnover. This section is an old section which was brought to give benefits to new manufacturing units set up after 1st March 2016. To avail the benefits of this section, various deduction as mentioned in condition 4 in the slide needs to be foregone. Not only this, the brought forward losses and unabsorbed depreciation of earlier years pertaining to above deduction shall not be allowed to be adjusted. Now coming to section 115BAA, that is 22% tax rate, and the provisions of MAT shall not be applicable. One very important point which should be noted before availing this section is that the option once availed cannot be withdrawn, which means this section will be applicable for all the subsequent assessment years. To opt this section, various deduction as mentioned in condition 1 should be foregone. Further, the MAT credit, unabsorbed depreciation and brought forward losses pertaining to above deduction cannot be adjusted from the income. It would be beneficial if we are able to adjust brought forward losses and unabsorbed depreciation pertaining to above deduction before opting this section. A CC can postpone opting this section until all the brought forward losses are adjusted. Rate of 22% looks very lucrative, but the rate of surcharge applicable shall be 10%, irrespective of total income. Even if the income is below rupees 1 crore, surcharge shall be applicable. Hence, rate of tax shall be 25.17% effectively. Now let's discuss section 115BAB, that is 15% tax rate and MAT shall not be applicable. The benefits of this section can be availed by new manufacturing units registered and set up after 1st October 2019 and has commenced manufacturing before 31st March 2023. We should keep in mind that value of old plant and machinery should not exceed 20% of the total value of plant and machinery installed. However, old plant and machinery imported from other countries can be used. Then old building which was used as a hotel and benefits of section 80 ID have been availed cannot be used. As discussed in other sections, various deductions should be foregone to avail benefits of section 115BAB. Unlike section 115BAA, a CC cannot postpone opting this section. Also, option once exercised cannot be withdrawn. The rate of surcharge shall be 10%. Hence, effective rate arrives at 17.16%. We should also note that the following business are not manufacturing business for the purpose of section 115BAB. Those are development of computer software, mining, conversion of marble block into slabs, bottling of gas cylinders, printing of books or production of cinematographic film, any other business as may be notified by central government. So friends, we must be very careful and analyze the conditions before opting a particular tax rate for this assessment year. Thank you for watching, friends. Stay home, stay safe.